Yogah Karmasu Kaushalam.
Hello friends, I am Professor Srenik Shah. Today in this session, I will discuss the concept of decision making with reference to make or buy, add or drop a product issues. Meaning, make or buy decision is simply the choice between making a part or article within the company and purchasing it from outside. Considerations for taking a decision to make or buy. Number 1, spare capacity. It has to be seen whether the firm has spare capacity to make the part or raw materials required. It has to be considered whether the spare capacity can be put to any other more profitable use. When the firm decides to make its component parts, it does not remain dependent on its suppliers or distributors, as for example, when there is a strike in supplier's factory, it does not affect the production program of the firm. Secondly, when it makes its own parts, it not only gets profit from its main activities, but it also gets the profit from manufacturing parts. Number 2, element of risk involved. Before the firm decides to make the part in its own factory, it must consider the element of risk involved. It must be satisfied that there would be a saving in cost, and at the same time the quality of the ultimate product must be maintained. It must also be sure that it will be able to produce the part in sufficient quality, as it has to compete with its own suppliers and they would not supply the parts in case of need. Number 3, the cost of manufacturing the part. It is an important consideration to compare the purchase price of outside supplier with the marginal cost of manufacturing the part. So far as the variable cost is less than the purchase price, it would be profitable to make in the factory. Number 4, alternative profitable use. It must also be considered whether idle capacity can be put to any other use. It may be found that a new market can be developed and the current product can be sold there, for which the unused capacity can be utilized. Number 5, the additional fixed cost. An additional fixed cost may be incurred when the part is to be manufactured should be considered. Thus, all additional costs that will have to be incurred for manufacturing the part must be taken into consideration. Number 6, additional capital investment. Another factor that is bearing on the decision is the additional capital investment that has to be made. It may be that additional production facilities may have to be installed, the factory has to be extended, the new machines or equipments have to be purchased. This would lead to consideration of an additional investment. The return on additional investment must be taken into account while comparing the cost with purchase price. If the return is found to be satisfactory, then a decision to manufacture the part should be taken. Number 7, non-cost factors. Sometimes some non-cost factors have also to be considered besides marginal cost. In order to maintain business secrecy, a part, though cheaply available, may be manufactured in the factory. When to make parts, though available, cheaper outside. In the following circumstances, the component parts will be made in the factory even though it is available at cheaper rate from outside suppliers. Number 1, when the quality of the ultimate product may depend upon the quality of the parts, it would be better to make it so that the firm has not to depend on the mercy of the supplier for maintaining the quality of its product. Number 2, when the supply of part is not dependable and the production may be interrupted due to short supply of parts. Number 3, when the management wants to keep its design or process as a trade secret and does not want to pass that secret to the suppliers. When the part must be purchased though the price is high. In certain circumstances, the part can be manufactured cheaply in the factory, yet the management decides to purchase from outside. Number 1, when the quantity of parts required is small. Number 2, when the supply from outside sources is regularly available. Number 3, when special technique may be required to manufacture the part is not easily available within the factory. Number 4, when more profitable alternative is available to use the spare capacity. Number 5, when the capital required for manufacturing part is not available in sufficient quantum. Number 6, when the management feels that during busy season or during crisis the regular supply is available. This would happen when good relations are maintained with the suppliers. Procedure for taking a decision to make or buy. Number 1, produce a precise specification of the item and define the quantities required, the timing of deliveries and the maximum acceptable unit cost. Number 2, analyze the existing capacity to find out if the item can be made in accordance with specifications for quality, quantity and delivery schedule. Number 3, analyze tenders made by outside suppliers to find out which, if any, can best satisfy requirements for quality, cost limits and delivery. Number 4, calculate the incremental cost of making the item, that is the full accounting cost of the labor and direct material used to make it. The incremental cost will equal the marginal cost if and only if factory capacity is sufficiently underutilized before the make or buy decision is taken to render all fixed cost irrelevant to the decisions. Number 5, calculate the cost to buy, which is the purchase cost invoiced by the supplier, that is total cost less any trade discount plus any delivery and inspection cost and cost of buying, that is office, staff time, etc. Number 6, assess the opportunity cost of making the component as measured by the total contribution that would have been earned using the resource required to make the item to manufacture instead of an alternative more profitable product. Number 7, weigh the results of the various assessments listed above. A thorough make or buy analysis as outlined will ensure that all the capacity, capability, differential cost and opportunity cost factors will have been taken fully into consideration before the choice is made. Influence of level of capacity utilization. Make or buy decisions are best with full knowledge of the marginal or variable cost of making rather than buying a product, but it is also helpful to know through marginal costing what contribution to fixed cost will result from a make decision. Sometimes in manufacturing companies a problem may arise as to whether the component, subassembly or product is to be manufactured within the organization or to purchase from the market. This decision will be taken with the help of marginal costing technique under the situations. Number 1, when the company is working at full capacity, the contribution per unit earned by different components, assemblies or products will be arrived and the contribution thus earned will be lost by not manufacturing the component. This contribution lost will be considered whether to manufacture a component or buy it from outside. Number 2, when the company is not working at its full capacity, the lost contribution approach is irrelevant and should manufacture if it earns contribution over variable cost incurred on it. If variable cost in production is more than the purchase price from outside market, then only the company will prefer to procure from outside suppliers. Now, let us come to lease or buy. Sometime a question arises whether it is better to buy an asset or take it on lease. 3 points must be considered in these regards. Number 1, comparing costs of both the alternatives. While comparing cost of both, it must be remembered that the asset must be purchased. If the total cost of asset purchased is less than lease rentals, if the money has to be borrowed for buying the asset, the interest payable must be considered. If the asset is to be purchased with firm's own funds, notional interest at reasonable rate of interest must be taken into account. Besides, depreciation is an important factor to be considered when the asset is purchased. If, however, the money to be invested in buying the asset can be invested in any other more profitable avenue, it would be better to lease the asset. Another point that must be remembered is that the full lease rental is allowable deduction for income tax purposes. If the asset is taken on lease, While in times of rising prices, depreciation on an asset is allowed only on the original cost of the asset, which is very much less than the depreciation on replacement value. Number 2, liquidity of business. Liquidity of business is an important consideration. If the business needs funds which can be put to more profitable use, it would be unwise to buy the asset, as in that case money is not available for more profitable investment and the liquidity of business is adversely affected. Number 3, the risk of obsolescence arising on buying as asset. If an asset is purchased, the firm is expected to risk of obsolescence. Before the useful life of the asset is over, a new technique of production may be invented and the old asset becomes obsolete. While in case of leasing, there may be a condition that only modern machine must be put to use. Now, let us come to add or drop production decision. This is differential costing problem. With reduction in revenue, savings in variable cost and possibly some saving in fixed cost may result. The important question to ask is how much, if any, will fixed cost be reduced if the product line is dropped. In other words, does the contribution of the product cover the fixed cost which are incurred solely because of its production? The general rule is that common and unavoidable fixed costs which are allocated to production on the basis of apportionment are not relevant for decision making. Now, let us come to non-cost considerations. In addition to profitability considerations, the business manager must evaluate certain other non-cost considerations. With the dropping of a product, the sales of related products may be adversely affected if the products are complementary or jointly demanded. If soft drinks are no longer available to customers, Pizza's Corner might lose some pizza sale as well. Now, let us come to the example. Let us come to the first illustration now. The cost of manufacturing a part is given below on the basis of production of 1 lakh units. Direct material cost, part purchase from outside, cost per unit rupees 20, other material cost per unit 4, direct wages cost per unit rupees 6, variable overheads cost per unit 4, fixed overheads total 40 lakhs, it comes to rupees 40 per unit, total cost 74. The company is operating at 80% capacity and it will not be making any other use of balance 20% capacity in future. Hence, it contemplates to manufacture a part of the above product which it purchases from outside. The estimated cost of the part is as under: direct material cost, cost per unit rupees 4, direct wages cost per unit rupees 7, variable overheads cost per unit rupees 3, fixed overheads 20% of 40 lakhs, that is 8, total cost 22. Should the company make the part or buy it from outside? Let us come to the solution of illustration 1. We will have the 3 columns: particulars, when purchased, when manufacturing, and within that we will have 2 columns: per unit and total. Units under both are 1 lakh. Direct material cost, that is part purchased from outside, it is 20 per unit when purchased, total 20 lakhs, when manufactured 14 lakhs. Other materials common for both, that is 4 per unit, that is 4 lakhs in total. Direct wages 6 per unit for both, so 6 lakhs per total for both. Variable overheads 4 per unit under both the alternatives, so 4 lakhs in total. Fixed overheads rupees 40 lakhs, so per unit 40 under both the alternatives, totaling 40 lakhs for both the alternatives. The total cost for purchased comes to 74 lakhs and when we manufacture it comes to 68 lakhs. Thus, making the part would result into savings of rupees 6 lakhs. Now, let us come to illustration 2. Mona Electricals Limited is operating at 75% capacity. Its fixed overheads are 1,20,000. The company is presently buying one of its parts from the market at rupees 6 per unit. If it makes in its own factory, its per unit cost would be as under: particulars and cost per unit, direct materials 2.5, direct wages 2, factory overheads 1.20. If it works at full capacity, it can manufacture 60,000 units. The cost accountant has prepared the following statement and has presented that it would be costlier to make the part and buying it from outside would be cheaper. We have the 3 columns: particulars, cost per unit, total cost. Direct material 2.5 totaling 1,50,000, direct wages 2 totaling 1,20,000, factory overheads 1.2 totaling 72,000, fixed cost 25% of rupees 1,20,000, that is 0.50 per unit, total 30,000. So, total cost per unit will be 6.20 and total cost 3,72,000. Give your opinion about the above statement. Now, let us come to the solution of illustration 2. The statement prepared above is defective. When the firm is working at present at 75% of capacity, it is already incurring fixed cost of rupees 1,20,000. If you are manufacturing in the factory, additional fixed cost is not to be incurred. Hence, an allocation of 25% of fixed cost to the cost of manufacturing is wrong. The correct statement of cost would be as under. We have the 3 columns: particulars, cost per unit and total cost. Direct material per unit 2.5 totaling 1,50,000, direct wages per unit 2 totaling 1,20,000, factory overheads 1.20 per unit totaling 72,000, total variable cost 5.70 per unit and 3,42,000 total. Purchase price if purchased, it is 6 and total 3,60,000. Savings if part is made is 30 paise per unit, that is 18,000 in total. There is no other more profitable use of the 25% spare capacity of the firm if there would be no increase in fixed cost due to manufacture of the part. Now, let us come to illustration 3. ABC Limited manufactures a special table which has 3 components X, Y and Z, one of each being required for each table. The company is working to its full machine capacity of 28,000 hours per period and the machinery used is capable of making all the components. The tables are made in batches of 20 and the data relating to current production are. Let us have the 5 columns: components, machine hours, variable cost, per batch of 20, fixed cost and total cost. X component needs 6 machine hours, variable cost is 15 and the fixed cost per batch of 20 is 6, total cost comes to 21. Similarly, component Y 10 hours, 18 is the variable cost, 7 is a fixed cost, total cost comes to 25. Product component Z 12 machine hours required, 18 is a variable cost, 18 is a fixed cost. So, total cost is 36. The assembly cost, where the variable cost is 32, fixed cost is 13, total comes to 45, wherein the total cost for each individual product comes to 127, profit 23 and selling price 150. Over the next budget period, the machine capacity cannot be increased, although the assembly capacity can be increased as required. The budget for the next period is being prepared. Because sales are buoyant, the purchase of one of the component is being considered and the following quotation has been received. Component X, the price received is rupees 22 for a batch of 20, component Y price is 28 for a batch of 20, component Z price 32 for a batch of 20. The company has decided that one component will be bought from outside in one period. The sales director thinks that he could sell at least 50% more tables than at present and probably 75% more provided that production capacity was available. You are required to recommend which components should be bought from outside if production is increased by 50% and how many components should be bought. Number 2, recommend which components should be bought from outside if production is increased by 75% and how many components should be bought. Solution of illustration 3. The statement of contribution and ranking of components per batch of 20 tables. We will have the 4 columns, first column for particulars, thereafter the products, that is X, Y and Z. Price quoted is 22 for X, 28 for Y, 32 for Z. Variable cost is 15 for X, 18 for Y, 18 for Z. Contribution per batch, that is A minus B, 7 for X, 10 for Y, 14 for Z. Machine hours per batch 6 for X, 10 for Y, 12 for Z. Contribution per machine hour, that is C divided by D, 1.17 for X, 1 for Y, 1.17 for Z. Ranking first to product X and Z and third to product Y. As machine capacity is limiting factor in the present case, as the contribution from Y is lowest, the same should be purchased from outside. Number of batches produced is equal to 28,000 hours divided by 28 is equal to 1000 batches. If the sales director target of 50% increase in sales is achieved, the hours allocated will be as. So, let us have the two columns, particulars and hours. Available hours 28,000, less required to make X, that is 1000 plus 50%. So, 1500 units into 6 hours, that is 9000 hours. Required to make Z, again 1000 plus 50%, that is 1500 units into 12 hours is 18,000 hours. So, balance hours required to make Y is left out 1000 hours. So, we can make it 100 units only. Therefore, 1400 components of Y should be purchased from outside. To achieve 75% increase in sales, the only option is to subcontract Z, and this balances exactly. So, let us have the table with two columns, particulars and hours. Available hours 28,000, less required to make X 1000 plus 75%, that is 1750 units into 6 hours 10,500 hours. So, required to make Y 1000 plus 75%, that is 1750 into 10 hours, that is 1700 hours. Therefore, purchase 1750 components of Z from outside. Now, let us come to illustration 4. A company has an opportunity to obtain a machine on a monthly lease rental of rupees 2000. However, if this machine is bought, its cost would be rupees 1 lakh. This machine would have useful life of 8 years only. The machine is likely to realize rupees 12,000 at the end of its useful life. If the machine is purchased, the funds have to be borrowed at 10%, while the same funds can earn 14% return if invested in business. In such situation, give your opinion whether the machine should be bought or should be taken on lease. Now, let us come to solution of illustration 4. Let us think about the cost to be incurred if the machine is purchased. We will have the two columns for the calculation, particulars and rupees. Depreciation 1 lakh cost minus scrap value 12,000 divided by 8 years life. So, it is 11,000. Interest on loan at 10% on rupees 1 lakh 10,000. So, total cost 21,000. Therefore, monthly cost will be 1750, that is 21,000 divided by 12. Now, A, thus the monthly lease rental is rupees 2,000, while the monthly cost would be 1750 if purchased. Hence, if only cost is concerned, it would be profitable to purchase the machine. B, another point is that the money borrowed as loan of rupees 1 lakh at 10% can be invested in business at 14% return. Thus, it would earn 4% more on rupees 1 lakh, that is more profit by rupees 4,000. Now, total cost when the machine is on lease is 24,000 per annum, less cost when machine is purchased is 21,000 per annum. However, if machine is taken on lease and bank loan is invested in business instead of purchasing a machine, with it the additional profit, that is 4,000 minus 3,000 is 1,000 per annum. So, coming to the third point, finally, the profitability of the machine becoming obsolete when it is purchased must also to be taken into account. Summary: in this module, we learned the meaning of decision making to make or buy, factors affecting the decision making to make or buy, the procedure and conditions affecting the decision making to make or buy, and other considerations required for the decision to make or buy. Thank you.